Hi everyone, today we're with Johnny Chen from Ascent Tailored Finance, and you know who I am, Mina from Pinnacle Accounting Advisory. And Johnny, what are we discussing today?
Today we're talking about DPNs, or Director Penalty Notice, which has probably become something that's very common these days amongst my customers and clients. So I wanted to cover on that, and then we also want to cover a bit about structures, purchasing properties under a trust, and how, I guess, that could work for some of our potential clients.
Yeah, absolutely. I mean, the Melbourne market at the moment is quite hot. So a lot of people are snapping up property in Melbourne, and they want to make sure that they're structured the right way so the bank approves the property finance, because sometimes when they have it themselves, then they can't service the loan and the bank stops giving them the finance. So they're two very, very important topics. And I think in relation to DPNs, there's still a catch up from COVID, where business is still struggling, and now they're going under. Right? But it's also important to look at their planning, their reporting, and are they on top of this or not? So over to you. Tell me what you're seeing at the moment and some of the cases that you've come across.
So DPN, so Director Penalty Notice, basically there's two types of Director Penalty Notice. There's what we call lockdown and non-lockdown. So non-lockdown Director Penalty Notice is where the ATO provides you with a notice, and effectively you've got 21 days to either pay the full ATO debt that is overdue, or go into administration or liquidation, or look at restructuring your company. At that stage, you're not personally liable for that ATO debt. It still lies under the company's name. However, if there's nothing being done after 21 days, it may become a lockdown penalty notice, which means that yourself as the director of the company then become personally liable for that debt. At the moment, I guess what I'm seeing at this stage is the ATO are going very hard on those director penalty notice. I think at the moment they're just trying to chase up all these debts that is overdue. There's not much concessions being made to business owners. So if you are someone who's starting to accrue a bit of a ATO debt, it's very important to get on top of that from the onset.
Yeah, look, absolutely. And a big one is making sure you lodge your business activity statements online, your BASs, AISs, all those important statements, because if you don't lodge on time, you'll actually get a late lodgement penalty, number one, and you're going to get general interest charge, but it's going to be higher, right? And the other thing is you're going to get blacklisted. So even if you want to negotiate with the ATO to potentially remove general interest charge, remove penalties, it's going to get harder and harder, because they'll just say, listen, you're not really complying with the requirements, and so there's no reason for us to actually help you out, right? So very, very important. So first and foremost, make sure your accounting program is being reconciled on a regular basis. One of my favorite programs is Xero. It's just very, very user-friendly, and more and more accounts are actually moving towards using Xero and becoming Xero practices because of its user-friendliness and its ability to integrate with different programs. But ultimately, make sure you're reconciling on a regular basis and you're able to lodge. When you reconcile on a regular basis, you're also able to generate reports and find out exactly what the business is doing, and make sure you're lodging on a regular basis, meeting those deadlines. Yep.
Most definitely.
So what does it mean when a director becomes personally liable?
Effectively, what that means is that on their own tax return, they've now all of a sudden got a lump sum ATO debt, which they now become liable. So whenever they have a tax credit, I guess at the end of the year when they lodge the tax return, that goes straight to paying down that ATO debt. So it could be quite significant.
Is the family house up for grabs?
It depends on how the structure of the family house is set up. Some people would set it up slightly differently for asset protection purposes, but it all depends on ultimately how it's set up.
So it's important to be speaking with your accountant or reach out to us. We can have a discussion, find out exactly what's happening. One of the best things to do is to potentially have the partner or the person who's running the business who's at risk not holding the family home, right? So if, as the husband, you are the person who is running the business you want to be holding the family home, the wife would be, or vice versa, right? So that way, if you become personally liable, the family home is not up for grabs. But in terms of a marital breakdown or relationship breakdown, then the family home can still be considered as part of the family group and family pool of assets, okay? So just things to keep in mind. What else, Johnny? The ATO is also becoming very aggressive in terms of general interest charges and not allowing those to be deductible. They're no longer deductible, right? So I'm seeing every time I call the ATO, even if there's extenuating circumstances, it's becoming very, very difficult to get general interest charge remitted, right? Although, and despite of the fact that the circumstances are outside of the client's control. And I'm hearing other accountants also, when they lodge an objection, they initially get the objection not accepted, right? So they don't get the GIC refunded, but they have to lodge another objection, right? I called the ATO today regarding an objection that's been outstanding now for 2 months. 2 months they haven't come back to us, right? And I said to them, can you give me the complaint department's phone number? And can you switch me to them? And apparently, even the complaints hotline is absolutely slammed with calls. So it's getting a bit ridiculous, quite frankly, at the moment at the ATO. But yeah, look, things to keep in mind, just as much as you possibly can, working with the different professionals, manage your affairs so you are meeting those deadlines, and so you don't have to really deal with all these backlog of objections and whatnot.
And I think also important to mention as well, with the ATO, I've got a client at the moment who's got a default that's been listed against the company. And effectively, because the repayment is quite high, with the ATO, we're trying to look at refinancing that ATO debt. Now, unfortunately, because he's got a default on his company name, none of the banks are willing to look at this particular client because of the default that's there. So it is super important to address it at the start, because as soon as the ATO places a default on you, even your second tier, third tier banks aren't willing to really look at, providing finance in those instances. And I guess to add to that, on a personal level, if you are looking at taking out a loan or finance and you've got a DPN listed against your name, that makes it extremely hard to get finance, especially with your first, your big four banks, because the way that they view it is that they will not want to provide finance to someone who can't manage their affairs. So it's really important to be on top of it.
And look, one of the biggest reasons people actually fall behind is because they are not reviewing their reports. They're not reviewing their profit and loss. They're not reviewing their balance sheet, at least very minimum on a monthly basis, okay? That will allow you to know what your future commitments are in terms of the repayments that you need to make, because a lot of the repayments actually, they don't sit in the profit and loss statement, they sit on the balance sheet, right? So a lot of business people, they might look at the profit and loss and say, looks like I'm profitable. Okay, but what does the balance sheet say? Because principal repayments, it's not an expense, okay? So it's coming out as a cash flow item, but you're not really projecting, you don't have that in mind. So what ends up happening is you see this profit and you think, I've got all this profit, which I can go and spend this money, but effectively you can't, because this is not your cash flow position. Things to keep in mind. And then you start getting in trouble, right? Because when you have all these obligations, GST, superannuation, all that stuff you need to pay, you don't have any money. Because you've already spent it on things that you probably didn't need to spend it on. All right? And just spending for the sake of getting a deduction is not a very wise business decision, because at the end of the day, whatever deduction you have, a percentage of that will be the tax. So say, if you're in a company, it's 25% tax rate, every deduction is only worth a benefit of 25 cents in the dollar, but you're foregoing the whole 75 cents just to get that 20. It doesn't make any sense unless it's actually helping the business to grow, whether it's advertising or you're getting employees in, salespeople in, so on and so forth. So you gotta make sure that every dollar you're spending has a return on investment.
Most definitely.
Beautiful. Shall we jump onto the other topic or any other comments?
Yeah, probably the other topic. The other comment about the ATO debt is, even if you do go into a payment plan with them, generally it's over, I think it's 20 months, the payment plan, which does impact, a lot of businesses when it comes to cash flow. So as alternative options, there are finance companies out there that could provide finance, unsecured lending, of course, over a 3-year loan term, which means that debt that you've got could be spread over a longer period, which reduces the amount that you need to actually pay, which is super important when it comes to businesses, because cash flow is king. So you're not all tied up just paying down the ATO debt.
Absolutely, and that interest will be deductible.
Yeah,
because it's not that you're not paying it to the ATO, you're paying it to the actual lender.
Yeah.
Sometimes they can actually go longer than 24 months in terms of the ATO, but then there's more stringent requirements. So you're going to need to provide profit and loss. You're going to need to show them how you are going to actually meet that loan obligation. Again, if you haven't been lodging on time, that's just going to be very, very hard to do, right? Just to be very, very frank. Another thing you can do is, if you are monitoring your profit and loss, your balance sheet, your cash flow, and you see that you are incurring all these debts with the ATO, you can enter into what they call a small business debt restructure. And that might mean that you pay the ATO a few cents in the dollar. But again, there's requirements for this. There's turnover requirements, there's debt requirements. Some debt can be restructured, some debt can't be restructured. So for example, superannuation, you need to make sure that you're on top of that. But things like GST, income tax, that might be restructured. Again, have a chat with the professionals. A liquidator is the person who administers this scheme, but it doesn't mean you actually enter into liquidation, right? It's a step before liquidation. Again, you need to have the chat with the various professionals. Reach out to me, reach out to Johnny. Look at what the options are. Do you need to enter into finance? Do you need to potentially go with a debt restructure? Reach out. Let's have that discussion, and then we can go from there. We can connect you with the right people too.
100%. And don't leave it till last minute, because it's very hard to get out of it.
Absolutely. But you've also got that mental strain of carrying it every night, right? It means you're carrying this with you into your business. It's impacting your ability to make business decisions, which is pushing you just further and further behind, right? So have the chat early on rather than later on, and then see how you can manage it. Okay? The next one is, move on to the next one?
Yep, let's move on to the next one.
Okay. Structuring in terms of here, we're going to focus on buying investment properties, be they commercial or residential. We're going to focus on trusts.
Yep.
So we're going to leave SMSF out of this equation for now. We'll look at SMSF another time. Yeah?
Yep.
Or do you want to touch up on SMSF briefly? Let's touch up on it very briefly.
Yeah.
Okay. But let's focus at the moment on family trusts and unit trusts.
Yep.
Yeah, because then you can structure these out into other entities at the bottom. You've got that flow through. Fantastic. Okay. So what's a family trust?
You could probably describe that better than I can.
So family trust is pretty much an entity that is entrusted with assets, and ideally you have a corporate trustee that runs the day-to-day management of those assets. That ensures that you've got a level of asset protection, because ultimately if something were to go wrong for a trust, the trustee is held liable and they're entitled to be reimbursed by the trust. So ideally we want to have a company, and the company is limited by the shares, and it adds that additional layer of asset protection. So when creditors go chasing you, they've pretty much got that company, and it's only the funds in the company that they can really reach out and grab, or whatever you've got in the trust. But again, it's going to be separate to another trust. It's going to be separate from your family house, as an example. Okay? And a family trust has the discretion to distribute the profit to different family members. That's high level what a family trust is. It's got the discretion to split the profits, which means when you split the profits out to different people, you leverage their lower marginal tax rate. So as a family group, you end up paying less tax rather than more tax, because one person isn't really burdened with being pushed higher and higher up the marginal tax rate and paying a higher level of tax.
Yep.
Okay. Now, in terms of the family trust and getting finance from a family trust, what needs to happen? Say, two people, they're a couple.
Yep.
They're going to buy a property.
Yep. So I guess the most common setup at the moment, from what I see, is basically people set up a corporate trustee, where the guarantors, the beneficiaries of the corporate trust, the husband and wife. That's probably the most common one that I've seen, and I guess the reason why it's becoming more popular as well these days is like what you mentioned about the fact that it's isolated, it's quarantined from the rest of the assets that's held under the personal name, and similarly that's how the bank treats it when it comes to lending as well. So when you look at your borrowing capacity, most people are capped, because once they get to a certain amount, they can't actually borrow more. Whilst if they set up under a trust entity, the banks would quarantine that commitment that's held under the trust as a separate entity, effectively meaning that it actually doesn't have an impact on your borrowing capacity, which due to the interest rates and the borrowing power, it's getting less and less. So it's becoming something that's more and more common on the market.
So this is as long as you're still personally guaranteeing that loan, is that correct?
Yep.
Okay. Does the bank look at the ability to finance that loan, or how does it assess the trust's ability to finance that loan to still be able to provide that loan?
Yeah. So the bank will look at the guarantors that's on the loan. So effectively, they will still look at your individual income and your serviceability to see if you can service that debt under the trust. However, once that's been set up, that trust and the loan that's held within the trust is a separate entity. So effectively, if you were to borrow for another property in the future, as long as the first property that you've set up is able to manage and repay the commitment that's held within it, the bank would quarantine that from the serviceability.
Okay. So in terms of that example, for it to service its own debt, does that mean the property effectively needs to be positively geared? Or if it receives a distribution from another family trust, it would still tick as it's able to meet its own debt?
The wording from the bank is if the individual does not receive any distribution, or we do not require the rental income from that property that's held within the trust, and the income that's coming in is able to meet its commitment responsibilities within that trust, then that's fine.
So effectively, does that mean the property needs to be able to meet the interest repayments and all the running expenses? It can't rely on another trust giving a distribution? Is that what we're saying here?
That's correct,
Yeah? Okay, all right. So important to, as you're structuring your loan, I guess, to make sure that the interest and repayments, principal interest repayments aren't so high that you can't pass that test, right? So you've got to be mindful of that, right? So have a high enough deposit. What are some ways we can manage that situation?
Be smart with the properties that you're purchasing. I think a lot of people nowadays are utilising buyers advocates at the moment, because trying to find a bargain where the rental yield might be a bit higher. So I've got a few clients that are buying up in Queensland, up North Queensland, where the return's about 6% rental yield. Look at the repayment type that you've set up, whether it's principal interest or interest only. Also look at, obviously how much deposit you're going to put in and how much of a loan that you're going to take out. Because if the rental's unable to meet the repayment of the loan that you've taken out, then obviously this won't work. But I think ultimately as well, just got to be strategic with the structure. It's not for everyone. Some people are probably a bit more savvy when it comes to setting it up, but I think it's a very kind of case by case. It's definitely not for everyone.
Agree. And it depends on how many people you want to merge your funds with. A family trust might not be right for you. You might say go for a unit trust, and that unit trust will be held by other family trusts. So say two families are coming together, they're pooling their funds in the unit trust to be able to purchase that property, right? I guess in terms of the unit trust getting a loan, it would be a similar situation. who's ultimately guaranteeing the loan, and there need to be, I guess, directors, and this family group ultimately needs to be beneficiaries of that unit trust, I gather.
Yeah. And I think with that, it does get very complicated if you're going to have two different families all get involved, because one family, might be at a certain stage might want to grow their portfolio, another family might not want to. So I think, it's very rare that you have two different families all pull their money together to, set up a trust.
Yeah. If that is the case, if you do have two family groups coming together to pool their funds in a unit trust, as an example, to buy property, and one family group is making other decisions in terms of, okay, well, we want to buy more or we want to buy less, you can always set up either a separate family trust that's holding that property directly, or you can set up another unit trust separate to the first unit trust to be able to cater for those decisions and those needs. So it's definitely something that can be done, but you need to have the conversation and plan long term. These are not short term decisions.
Yeah.
Another benefit of family trusts is when people buy a property that's negatively geared and they hold it in their name, they're looking at short term gain, because the negatively geared property reduces their taxable income. But the biggest issue that they face is when they come to sell the property and the huge capital gain that they're going to end up with. So it's as if like you're taking a few steps forward, but you're taking major jumps backwards, right? When you come to sell the capital gain, the property and the capital gain. So having a family trust will allow you to split that capital gain between your different family members, and ultimately you might even decide to pass a percentage of that capital gain to a company that's going to get taxed at potentially between 25 to 30%, depending on the ultimate flow of funds and the character of those funds that are landing in that company. Make sense?
Makes sense, yeah.
A bit complex?
It's I mean, look, you can make it very complex when it comes to this type of structuring, which is, what I said earlier, it's not everyone's cup of tea.
Absolutely.
But you do definitely need the advisory service, make sure that, you've got it set up correctly based on your, financial goals as a family.
And this isn't a piece of art, right? The more complex doesn't mean the more beautiful, okay?
Yeah.
The best thing to do is to keep it simple, right? Keep it simple, silly, or keep it simple. People say stupid, right?
Yeah.
But ultimately, just keep it nice and simple. That will allow you to understand exactly what's going on with your group, be that a mix of trading entities and investment entities, or just investment entities. And that will allow you to be able to speak to financiers, to speak to your team, and understand also how the cash flows, right? And you'll be able to project and manage that growth going forward. Yeah, because the last thing you want is to be able to jump onto your accountant or your financier and say, oh, how do things flow again?
Yeah.
And you're always confused about it. And look, we do get some business owners that do go through that, and completely understandable. Everyone specializes in their own field, right? So reach out, have the conversation, and definitely get the help. Anything else in terms of family trusts and unit trusts, or any other kind of trust?
Look, with the trust lending, make sure that if it is something that you're interested in, definitely speak to a broker in regards to it. Just because different banks have got very different policies and niches when it comes to lending under a trust. So definitely reach out to a broker. If you're just reaching out to the one bank specifically, you're effectively having to mold the structuring of your trust based on their requirements. However, you might find that there might be another bank that be able to cater to the structure that you want. So I think that's where it's super important to reach out to your broker, have a chat with them, and explain the structure that you want to set up, and see which bank can accommodate that type of structure. Just
very quickly, how would lending work for a self-managed superannuation fund? Just very quickly.
Yeah, self-managed super fund, basically they look at three requirements. So again, they look at the borrowing under self-managed super fund. They don't look at your personal liabilities or personal commitments, which allows people that have a large super balance to potentially purchase an investment property. They could also purchase a commercial property as well on a self-managed super fund, so you're not just limited to a residential property. They look at three components. So they look at the contribution over the last 2 years, or by the people that within the self-managed super fund. They're also looking at the rental yield of the property that's coming in as well. And then they finally look at the overall balance that's within the self-managed super fund, which will make up for the funds to complete on that particular transaction.
Johnny, I think this is another complicated area, and we'll have another session, I think potentially with half the time dedicated to this, to really get an understanding of how you set up an SMSF, the requirements in terms of financing, and all the, again, detailed
nuances,
stuff, so you understand what's going on. Any final thoughts, Johnny?
For me, DPNs, address it as soon as possible. Don't leave it hanging. And with trust lending, definitely speak to a broker, because it is very niche. It is very specialised. Different banks have got very different policies.
For me, if you're serious about growing, make sure you've got a zero file as an example up and running, and you're reconciling. Doesn't matter how small your business is. If you fly a plane without instruments, you don't know where that plane is going, right? You don't know if it's upside down or where on earth it's going, okay? You might be heading for a lot of trouble. So make sure you've got an accounting system that's reconciled, so you can generate meaningful reports. Your lodgements are up to date, your tax returns, your business activity statements, because the bank wants to see those documents. If you don't have those documents, some of the tradies out there, they rely on cash, they don't declare their income, which isn't right, it's illegal. But ultimately what that means is when you come to get a loan, it's not going to look great, you don't have the visibility, so you're going to end up going with the non-major banks, and you're going to be paying higher interest rates, right? And if you think, okay, I'm going to pay cash for a car, I'm going to pay cash for a boat or whatever, the ATO data matching these days is very, very extensive, and you've got AI now that's also being used. We've had things such as people who are gambling online, and that income that they've received is actually being reported, and the ATO is chasing them up and auditing them, right? This is them pretty much being engaged in a hobby. It's not even a business, right? But the ATO can look at these and say, okay, you are running things in a form of a business, and therefore we're going to treat it as a business and go for whatever profits that you made.
Wow. Okay.
You've got to be very, very careful. It's getting more and more difficult, right? People think they're being smart about getting cash and whatnot. Look, at the end of the day, you're going to be ending up hurting yourself. Reach out to the professionals. Talk about how to manage your profits using wise structures, using financing, right? Use the bank's money, and make sure that you're growing instead of day to day. You've got that headache of, how am I managing this? Am I going to get audited? What's going to happen to the family home? What's going to happen to me? Am I going to end up in jail with Big Baba, right? Avoid Big Baba. The point is, just make sure you're on top of it, reach out to professionals and have that chat.
Most definitely.
Fantastic. Thank you everyone for being with us, and we'll see you on the next one. Cheers, Johnny.
Cheers.